And it's beautiful, right? Everyone is happy because they have no clue. You, when you buy a deal from a sourcer, pretty much you have no clue as well at the beginning of your career. Welcome to the Zen Properties Podcast, a podcast about building long-term wealth and cash-flowing businesses through real estate. Dive into interviews with industry legends, content packed with actionable tips and relaxed banter. We are Mac and Maggie Daring. Please enjoy the show. Hi guys, what's up? This is Mac and Maggie Daring from Zen Properties. We run a small family-run development company and this small little podcast right here. How are you doing, Maggie?
Yeah, all good, thank you. How are you today?
Never been better in my entire life. Thank you very much for asking. Most importantly, what did you have for breakfast?
Porridge.
Was it good? Why not?
Not my favourite, right?
So I'm slaving, doing the porridge in the morning for the entire family, looking after 2 kids so she can exercise. And then you say it's not the best thing in your life that you've ever had.
Yeah, you know.
She's a monster.
I'm sorry.
Okay, next time she's having McDonald's delivered to the doorstep. Alrighty, so a little bit more about us for those who are tuning in for the first time. We've got 6 assets, I think, in our residential portfolio. So we've got Stonyhurst in Northampton, a 3-bedroom buy-to-let property. We'll be talking more about a buy-to-let. We've got our family home here. We've got 3 flats, and we've got 50% of the Cotswolds big-ass holiday let. So roughly the equity in all these assets is $500,000 right now. We should be at $1 million mark this time next year. So we are not yet millionaires.
Not yet, no.
On top of
Fingers
that,
crossed, yeah.
On top of that, we are creating 9 bedrooms HMO in Swadlincote in Derbyshire right now. So the project is ongoing. This will add some extra equity to the portfolio, and we have 10 R2SA units across the UK, mostly in central London, and some in Oxford, Cambridge, and I think that's
Gloucester, right?
Yeah, and yeah, but that's Cotswolds pretty much.
That's Cotswolds, yeah.
Yeah. Okay, so if you want to tune in to this podcast, probably the best is to tune in on YouTube because you can see our absolutely amazing faces there. But it's also super feasible to listen to us in any audio platform, Spotify, Apple Music, Amazon Music, whatever you use, we are there. So tune in there. And very important, tell a person or 2 or 5 about this podcast if you get any value from it, because it helps us grow, and we need to have organic growth for us to find time, have time to keep creating this content for you guys free of charge. Thank you. Righty. So today we'll be talking about property investment strategies. Different strategies, different categories of investment strategies. We'll be talking about the service-based strategies where you sell your soul, so you exchange your time for money, pretty much like a prostitute. And also we'll be talking about the equity-based property investment where you create a long-term wealth. Okay, so first let's start with a quick disclaimer. We are only talking about strategies that we have done ourselves or we are very close to. So this is based on experience and education and not only theory. Okay, so we've done that, we've been there, so we know how it works.
Yeah, and anything we talk about tax, obviously, again, it's something we've done, we are aware of. We've checked, not something that, again, we read in textbook. So again, it's always important to consult your accountant because sometimes, obviously, you might have a slightly different circumstances and that might differ in terms of tax treatment.
True. You sound so credible, Maggie. Do you offer any consultancy services?
I don't have time for it, but no, we focus mainly on properties and our business here. Yes, we do. So yeah, I do support you guys, but I can refer you to some really good consultants if you want.
We've got one.
We've got one.
Quite trustworthy. Okay, so let's.
I don't know anyone else actually.
Let's start with the first strategy, a service-based strategy, which we've discussed quite heavily.
So obviously it's a strategy that we have started from. It's R2SA. Have a look at our previous episodes. We've done a very detailed talk about a Rent2SA strategy and how to go about this, all the pros and cons, small or bigger fuck ups we've done in the past, so all the lessons learned. Have a look on our site for that. So Rent2SA, it's an amazing cash engine, right? So just for the cash flow, if you want to begin from that, but it's you exchange your time for money, right? So it's not the strategy where you think, I'm going to just sit at home and it's going to sort of earn the money on its own,
passive income,
passively, and that's what everyone else says, right? You get all these they sell you the dream on many platforms. You get all the shorts on Facebook, and I still cannot believe it until today when I listen to some of the sell the dream people. Obviously they want to get a lot of attention there, right? They want to.
That's a marketing.
Yeah,
right?
A great marketing thing, but it's not.
It worked on you though, and me.
It worked for us, but I guess you still need to work your ass off, which is obviously not a surprise. I would say.
Abby said that you only need one Rent2SA unit to replace your income. Of course, it's not true, but that's what she said, and that's where we.
I'm sorry, we shouldn't really laugh, but I guess that is, it's a good marketing cut, right? You think it's so easy. Nothing is easy in life. You still need to put a lot of effort in it.
But to be absolutely honest, it depends on your salary, right? So a single Rent2SA unit done to a high standard across the 10 units that we have is roughly across the year 2.7k net profit a month. Every single unit. So it is a lot of money when you think about it.
Yes.
Yeah, I've done my numbers. Yeah. Okay, so let's quickly touch up on the basics of Rent2SA. Let's not spend too much time on it because we've spent like 1 hour and 15 minutes last week or 2 weeks ago. So let's start maybe with, the contractors versus high-end, super quickly. Right, which one do you prefer?
We personally, contractors are super easy. A lot less effort in terms of decor and everything else. Obviously, you spend a lot less money investing into Rent2SA. Your clientele is a lot less demanding. Very easy guests.
And it's easier
helpful.
To scale, isn't it? Because you can keep going.
Easier to scale. Exactly. You can keep going if that's what you would like. Yeah, by all means, less money per unit in terms of cash flow. But as you said,
8 times less. On average.
Exactly. So on the flip side, you can get more high end. You need a lot more cash flow to invest in it. You get a return after 18 months. You're going to touch on it. So a lot longer to get a return. So you can still scale it, but you get a lot more cash for it on a monthly basis. In terms of locations, we normally focus in London and some of the more prime locations such as Oxford, Cambridge, all the tourist locations where you've got people coming, wealthy people or coming from abroad. That would be our most likely our
But for contractors, it's simpler because every big city works, right? So it doesn't matter. It doesn't have to be like heavy on holiday lets for holiday makers. For contractors, anything like above, let's put a number to it. 100k population works for contractors market.
And we do have colleagues who focus on the contractors market, and that's what they've done, and it works for them. We personally didn't choose it. Because it's not our style.
Right?
We've tried it.
We dipped in, sold it.
We didn't actually have. Maybe we're not too lucky. We didn't have enough, a lot of income from it, right, in terms of cash. So we didn't see that.
We've done one contractors unit in Northampton to a high-ish standard for contractors. When it comes to contractors market, it was quite high end, and it didn't produce pretty much any profit, right? It was negligible, a few £100 a month.
Yeah, but again, that's in our experience.
But if you have 10 of those, it's a few £1,000s a month, right?
That is true, and it takes a little time to. Well, actually, it still takes time to set everything up, right?
Yeah, but it's like 3 days versus 3 weeks.
But it's not our style. We cannot bear a sort of a reasonable quality of finish. We we do like to make it perfect, to make it lush, and we do have a lot more enjoyment from providing
satisfaction,
a lovely accommodation where we know that people are stunned by and they enjoy their stay in our essays, and that's our style.
Yeah.
So depending on what your style is, go for it, right? In terms of, so let's focus on the higher end because that's what we do. So locations we focused on, all the time. Amenities, again, you need to think about out of the box, so make it quite high end. You know, we normally put an arcade machine, a pool table,
sauna sometimes.
Sauna, you know, stuff for the kids in the garden if it's a big house,
hot tub.
trampoline, hot tub,
gazebo, barbecue.
Exactly. Yeah, barbecue. We've got an electric barbecue these days. So anything that can make, you know, anything extra.
Plus high quality furniture, not like a bespoke furniture. Some of them they are bespoke, but most of them they are like cheap-ish, but not super cheap. So we have some furniture from IKEA and some furniture from Dunelm, some furniture from
but
Dow's.
you cannot tell because you mix and match, right? And the trick is that you buy high-end bits and pieces, and then you sort of balance it out with things that are less visible, or like, you know.
Yeah, true. You cut corners where no one can see that.
And when you take pictures, you take a picture of all the luxury items. So these are more like high-end items.
Yeah, Smeg appliances,
Exactly.
Smegma appliances. I can't believe it's so popular in the UK because of the name. You know the Smegma is, right? If you don't know what Smegma is, Google it right now. Okay, so in our opinion, R2SA business is becoming more and more difficult because of the rise in competition. Because
legislation.
And legislation. Most notably, there is pretty much no legislation yet when it comes to licenses and extra use clause like C5. Probably it's coming, who knows? And we don't know what's going to be required yet. So it's risky. You create stuff that you can lose overnight, that you can lose a license to operate it if you need that license to operate it. So that's risky as shit. And also double cancel tax for all the residential properties that are not your main residence. So that sucks. They started catching up on this. So we are paying like shitty Wakefield £400 a month for cancel tax. So now we're in the process of moving to business rate.
Exactly, and I bet this is not going to stop, especially with the new government, and with all the new people still trying to make a living out of it, and I think they know what they're doing. They don't often. They just, you know. There's just so many new essays being created, and because of that, the government is going to go after it. I bet you, and this is just the beginning. But I would like to be more optimistic because obviously it's good for the market, right? But especially in London, it's a view that you take away all the residential stock away from the local residents. There is some truth in it, right? But again, it's good for the trade and for the economy.
I'm a deep believer that the open market should dictate all the rules there is.
Yeah, so the point is, SA was amazing when it first started. It's been ongoing. It's not a new strategy anymore. The government is going for it. They look where to fill out the tax gaps where they can, and it's a great opportunity for them. So when it comes to timing, I know many companies sell this as, you know, it's still a great thing to do, which I think it is if you know what you're doing. And you've got a lot of cash, and you are cash secured, and you've got a backup plan, and you don't leave your full-time job for it straight away.
True.
Yeah.
True. And like when it comes to the legislation also, like think about cases like Sonder case, for example. So they were running the TOMS operation, which is Tour Operator Management Scheme or something stupid like this.
Tour Operators Margin Scheme.
Yeah. Almost there. Okay.
So you got me confused there.
So basically, it was a default in serviced accommodation to use TOMS for VAT calculations where you are VAT registered, but you look at your turnover, you deduct all the expenses, which is a lot. So expenses in R2SA or even in B2SA with a mortgage is around 70% of your turnover. 30%, exactly 30.94 in our portfolio is income, is profit, okay, that stays in your bank account, taxable profit. So with TOMS, you put VAT on top of, you take 20% from this 30% left from a turnover. So your margin is still there because you pay VAT from your profit, not from your turnover.
So, on what?
Typically with Tom's, you pay
So
VAT from profit.
so VAT you pay on. So basically, you use margin calculation, right? So whatever you look at what you get as a turnover from your guests, less whatever you pay, basically your expenses for your SA running. So any expenses you pay to your supplier, and that's the margin. And you look at the margin when you look at the VAT threshold, right?
Yep.
So, but why do we even look at Tom's? I mean, sorry if I kind of jumped into
it's
your
fine,
point.
it's fine.
I think you were going to say something about the cash flow, right? Because
I was going to say that if you don't calculate your VAT from profit, but from a turnover, then you can just pack your bags and go home, literally. Because
right, so yeah. But
with 70% of expenses, if 30% of margin on turnover, if you take your turnover and deduct 20%, your margin becomes less than 10%.
Yeah, and now is the tricky part. Now moving on to aspects of any sort of tax and how it impacts your cash flow. Now, so why? Maybe let's take a step back. First of all, R2SA or any SA, whether it's B2SA or R2SA, is treated as a holiday accommodation for VAT purposes, and at face value that should be 20% of VAT on your turnover. So before deducting your expenses, and no one really cares that there is shitloads of other tax, because you're going to still pay corporation tax. No one cares about your losses, how much you're actually doing as a business. You pay VAT at face value, so it's quite
so wrong.
It's just cruel.
Most businesses
But
running
that's
service
VAT.
accommodation would have negative profits at that point.
Yeah, so many companies would use one company business for that, and if you still are, if you're still one of those companies, make sure that you checked whether you haven't gone through VAT threshold within the last consecutive 12 months, right? So every month you look at the last 12 months. Did you? Have you gone over 90k?
It's 95, I think, now. Something like that. Still 90?
So
Doesn't
have a
matter.
look. It's always around 90-something K. Have a look. And if you did, not good, right? So do try not to go over it. And if you do have a one company or still running, have a chat, find the good accountant and think about your setup, right? Now, why do we even think about Tom's? So Tom's initially has been created for holiday business, tour operators. We are talking about holiday agencies, right? Tourist agents. They're supposed to just take on a number of rooms in the hotel, repackage them and sell them on. They should act as a intermediary. That is the idea of Tom's. Now, the legislation hasn't been very clear, and there is a lot of gaps, and interpretation can be quite,
Broad.
Thank you.
You're
So
welcome.
that's why a lot of the companies looked at Tom's. So obviously, SA has been a new thing. Tom's has been on forever, but due to interpretation, a lot of the companies started to use Tom's as to reduce VAT, or more like delay paying VAT, because I would say that's it's going to happen, right? It's
But
inevitable.
you will, by using Tom's, as Sonder and others were using,
Right.
you are reducing your VAT bill substantially.
Of course. Now, but there is the tricky part. Now, HMRC has gone. They've used one company called Saunders, our friends whose turnover you've checked on Companies House,
Similar
right?
to ours now.
It's kind of similar to ours,
Which
so
is
they are not
scary.
even that big. And HMRC did make an audit on them, and they've challenged them, and that's the example of quite a recent case. Now. It's not that straightforward. I'm gonna talk about this in our
Next episode.
We've
said it like 3 times already.
But it's happening. We're gonna talk about more detail. But if you still one company, and your accountant told you it's okay to use use Tom's, I wouldn't be comfortable with it if I was you, because HMRC has now thought they've taken Saunders to court, right? They've gone in court a few times. There was one decision back in 2023 where court said actually Saunders is right that they can use Toms. Then HMRC have challenged it. They've taken them again to the upper tribunal, and they found different arguments, and the court and upper tribunal have done a U-turn on it, and the most recent decision is actually HMRC is right. You do not qualify as one company set up to use Toms, right?
At that point, we started shitting our pants.
Yes, so quite recently they must have taken, we don't know whether they've had time to appeal.
They did.
Did you find some information on it?
I know that they appealed. No more information as of now. Right?
So I was trying to look into official information. I couldn't find anything. I do hope they did appeal. There will be more information about any results of it at some point.
Yeah.
I
Okay.
suspect.
So we've discussed how difficult it is, like for the 5th time, because it is really annoying and difficult.
Yeah.
So every single time we have a little rant.
So super quickly, yeah.
How do you make it right?
How do you make it right?
Super quickly, in 5 sentences.
So first of all, you can use the managing agent. So a third-party company, you just
So it must be a
outsource
genuine managing agent,
genuine managing
completely
third-party,
disconnected from your company.
Completely disconnected. They would manage anything to do with face-facing, anything to do with expenses for your Airbnb, right? And you pay them the commission, right? They take a commission, and that's how it works. Now, the second thing that some accountants would recommend, it's a 2-company setup, PropCo, OpCo, and you've got a better chance. I'm not saying it's bulletproof. You've got a better chance to, kind of be compliant. And how it works, you are becoming yourself a landlord. You rent your ready, available, furnished holiday let to OpCo company, who is kind of acting as a managing agent, and you rent. A managing agent would then pay you a residential monthly fee. You need to set up a long-term residential agreement. Now that makes you being VAT exempt because you are renting out on a residential basis, and then the actual OpCo company is subject to Toms, and they calculate the sort of VAT on margin, right? But the idea is that the actual OpCo pays for most expenses, so like linen, cleaning.
So OpCo, not PropCo. So the management agent pays for all this.
PropCo,
yes.
Yeah. So the management pays for.
So management company is an OpCo.
Yeah, OpCo. Sorry, yeah.
Yeah. Okay.
And so like company 2, right? And you as a company 1, you are a residential sort of landlord, right? And you still pay for utility bills, repairs, right? As kind of normal landlord would do, right? Yeah.
Yeah, true. And also this is translatable to B2SA as well, right? So
Exactly.
when you buy the properties, you don't rent the property from a landlord, you are the landlord, nothing changes.
So
it's the same structure.
a lot of detail there, but that's the idea of that setup.
Okay, so that was still quite detailed.
Sorry.
It's fine. So now when it comes to high-end service accommodation, we wanted to give you an example like how it works, how much money we spend, how much money we keep, like how it works today. So the typical numbers for high-end 3 to 4 bed property, we get the property in the prime location, typically a shithole, okay? So we need to take a shithole on to add value and to convince the landlord that we can add value for their property by renovating it a little bit, like quite a lot, to be honest, pretty much every single time, to make the standard a lot higher at no or little cost to them. So worst case, we are contributing 50% to the renovation costs. So the landlords are ecstatic about it because we do the interior design, architecture, project management, staging, furnishing, everything, right? So that's great deal for the landlord and for us as well, because we have the property for 5 years or more. Now, to renovate a 3 to 4 bedroom property, typically we spend roughly £40,000 to furnish and stage, it's additional £30,000. And I'm talking about a box standard, right? So on our B2SA Cotswolds, we'll be spending way more. And typically, like now in Oxford, our new flagship that we are launching right now, we are spending like 10K or 15K more as well, because it's like a little bit bigger, a little bit more difficult, and a little bit more premium. Unexpected things, there are not too many unexpected things if you do just a renovation and don't go back to brick, right? So if you keep it simple, it's like pretty much nothing. So maybe let's say 1.5K. Plus first rent, you need to upfront rent. Typically you will have a rent-free period, but you will not finish your renovation in a rent-free period of 1 month or even 2 months sometimes. And in Oxford we had, I don't know, 4 months and we still didn't finish in that time frame, okay? Because it was a full back to brick. So total launch cost is 75K. So that's your investment required. And then to operate that unit, let's see how that works from the operation perspective. Monthly expenses are roughly £8,000 on average, okay? Between the low season, high season, whatever. Let's say it's £8,000. And on that £8,000, you have 3.5K rent, 300 council tax, 450 bills, cleaning 1,100. So that's for like a small-ish property. And for bigger, like 4-bedroom, it will be a little bit bigger bill. So 9 changeovers on average monthly, that's what we have. And maintenance and refunds are roughly 25% of all the cleaning costs. That's our real number.
That is a true figure.
Yeah, so it's not £50 a month, okay? So it's 250, 300, 400 pounds a month per property on maintenance, okay? So that's what you need to have.
And it's not something that we just sort of assumed. It's something that you've calculated in detail based on stats from the last 2 years.
2.5 years across the entire portfolio. Yeah, so that's a real number. OTA fees, so online travel agent, Airbnb, Booking.com, Expedia, whatever, they take 18%, 15% plus VAT typically, so it's like 2,350. That's a massive cost. That's why you want to have more direct bookings and not rely solely on those platforms, okay? Then insurance, consumables, breakables, these are cheap, so like, let's say 50 quid a month, and total is 8,000. Now turnover, your taxable profit. In high season, at 100% occupancy, you would have £18,000 turnover, which translates to roughly £10,000 kept on your bank account. But that's 100% occupancy. It never happens, or very rarely. You typically will have like 70%, 70, 80%. That's your sweet spot. And at that point, you will have £12,000 turnover and £4,000 profit in high season, okay? At 50%, you want to break even or have a small profit, and you will roughly have small profit of 1K at 50% with high-ish end. So expect that 70-80% occupancy in high season for high-end service accommodation, you should expect 5,000 profit. High season, I mean, it's just 4 months a year. December, June, July, and August. September is not, and anything else is not, okay? So just this 4 months. Low season, the remaining 8 months, you will have 14K turnover at 100% occupancy and take home 6K. 70%, you will have 10K turnover and take home 2K. At 50%, you lose £1,000, okay? So expected occupancy is now lower. It's no longer 70-80%, it's 60-70% in low season, and you will have £1,500 profit for these months. So on average, from all the units that we have, that is a range between 2 to 5 bedrooms, we have £2,470 a month throughout the year. And that translates, my friends, to 42% yield, which is still crazy good, okay? 42% yield is unreal, and there are hardly any other strategies or things you can do to have a yield as high as this. It's great. So annual profit is like £32,000 per property. With £75,000 investment, it translates to 42% yield. Okay, so let's switch to, that was it when it comes to Rent2SA. A lot of that will overlap with B2SA, so from now on we'll be a little bit faster.
Yeah.
So let's do the next service-based strategy.
So the next one is trading, and now I think that's a relatively new strategy, right?
Well, trading was always there, but it's becoming more mainstream now.
Yeah, I would say so. So that's when you buy a property, you have to be a good trader for it. You need to know how to find them. You find the property that it's kind of undervalued and you know that you will be able to sell it for profit but resell it. So when you buy it, the intention is to just trade and just, I would say flip it, but you know you're going to just sell that on. You won't be renovating it. You'll basically do nothing with it. You just buy it and resell it, buy it and resell it, right?
Yep.
So that is the idea.
But it's not as easy to find these properties massively below market value because you are not creating any new value. You need to buy cheap and sell more expensive, and your market of your buyers is typically also investors. So you still need to sell the property under the market value. So it's very difficult. It's very complicated. You need to be very organized and sales heavy to create the pipeline. Yeah, determined is the word.
Yeah, so it's very sales heavy, so it's definitely not for everyone, but can bring a hefty profit if you know what you're doing and you are, quite heavy on it, right? Because sales is basically quite a repetitive, heavy, in terms of
it's very difficult to learn sales as well.
Yeah,
so you
it's
need to
the
be born
numbers
a salesman.
game, right? It is the numbers game. As you need to basically do it pretty much all day long, right? And that is how you get results. In terms of taxes, it's quite easy. There isn't really much of complicated stuff that would impact your cash flow. So mainly it's just the usual corporation tax that you need to pay when you do trading. VAT shouldn't be really involved unless someone...
So say that again. You buy a property with intention to sell, and all you pay is the corporate tax.
That is
on
true.
Profit.
And the reason is the intention. If the intention is to resell, it's like trading shoes. So that's why we're just talking about corporation tax, because I assume you are doing it under a limited company. Therefore, this is sort of a compulsory tax you would normally pay when you file your accounts and your, your corporation tax return. Now, there wouldn't be any capital gains tax, again, because it's a true trade in HMRC.
And that's a very important point.
Yes, there could be VAT. There shouldn't be really, but if someone opted to tax when when they advertise the property and the VAT is involved, you can file a return, not a return, as just a piece of paper, a form called 1614D.
D for dick.
And or you need to pay VAT up front and then get the money back later, which you don't want to do. But that form makes it, it basically exempts you from paying VAT at face value, right, at source. And that's what you want because you need your cash flow. What also can impact your cash flow is SDLT. Again, you cannot really get away with it. And as we all know, residential rates are a lot worse than commercial. And when you've got a mixed use, then you just sort of apportion that. But again, you have to pay your SDLT. So from cash point perspective, you need to budget for SDLT and for corporation that is paid within 30 days after the actual purchase.
That's great knowledge to have.
You need to have that money.
Many people, they have it wrong in their heads, including me,
right.
from like a few weeks ago. I thought that every time you buy a property and sell with a profit, you are subject to CGT, capital gains tax, which is not the case with trading.
Yeah. And with corporation tax, there's a timing thing. So you need to you can keep your cash, but you have to budget for it, right? Obviously, you can have your losses and stuff, but budget for later. 9 months later after the year end, you still have to pay the corporation tax bill. So just budget for it. So, but other than that. It's quite simple, nothing extra complicated or, that would involve tax planning at all.
Okay, fabulous. So that's easy peasy lemon squeezy. Now, Maggie, tell me, what is the difference between trading and flips? Because that's also quite confusing.
There isn't much difference, really. The extra thing is that for the flips, you've got your renovation cost, right? So you can then look into, can I pay 5%? I mean, most times... you would pay 5% to contractors in terms of VAT. Not like professional fees, that's still 20%, consultancy and professional fees, but you will see on the VAT invoice anyway. But for flips, yes, ask your contractors to apply 5% because that's what should happen.
And they need to apply, the contractors that are doing the renovation of your asset, they need to apply 5% to who? What do they do?
Right, so 5% applies when it's a commercial to residential conversion, or or a residential property has been uninhabitable for 2 years. Now, the process is for you as a developer or a property investor to provide a letter explaining what relief applies. It's almost like a proof that you're going to use that relief. You're going to put all the details on that letter. It's a piece of paper you have to give to your contractor. And they're not going to apply 5% on their own because they're going to know what relief applies, or, you cannot assume that your contractor is going to know. And also they are not going to be willing to do that without any sort of paperwork in place. So it's your responsibility to do that. So have a look into that. And yeah, just make sure that you include this and think about this a lot earlier before you start receiving invoices from your contractors.
And yeah, that's amazing. So the contractors, they don't need to do anything. It's you as the project owner that needs to provide evidence, and this evidence that you're eligible for 5%, is dependent on different factors. So you can be doing a conversion to residential from commercial or mixed use. You can be renovating a derelict residential unit. So there are different.
Yeah, so have a look into your circumstances and see if 5% applies. If it does, you need to put it on a piece of paper and ask your contractor to apply 5% on materials and on services. Oh, and when it comes to materials, we can talk about this in our next episode, because it can become quite
LNPG.
Yeah, quite technical. And obviously your contractors often, they are not tax savvy, right? They can...
My contractors, they have a notebook and a pen and paper.
There you go. So moving on.
Okay, so we've discussed in flips, we've discussed the VAT. Yep. We've discussed that it's very similar to trading. So there is no CGT, capital gains tax, doesn't apply to flips because you have a intention to sell. And even if you do a full renovation of a flip, you are still not eligible for paying CGT. You just pay corporate tax.
Correct.
So that's amazing. Anything else that we need to? So you are still fucked deeply and royally by stamp duty.
Yes. So stamp duty, land tax, again, you cannot really get away with it on flips. So you still have to pay for it and budget for it in advance. That's important. There could be a reduced rate of SDLT, maybe if the property is like a derelict, maybe. But would you do a flip on that? I don't think you would you?
So that's the thing. It's very difficult to add enough value for the flip to work if you are converting residential to residential.
Yeah, you would.
In today's market, because the cost of materials is insane and cost of labor is insane as well. My contractors, they charge me $350 a day for head for the good guys, okay? And that's very, very expensive. That's a lot of money. So it's very difficult. You can add value easier. It's still possible to do it resi to resi, right? Like what we do with Cotswolds, it would make a workable flip if we didn't overspend as much money because we create a high standard asset there. But it would be possible. But it's easier to create value when you do flip from commercial to residential or from mixed use to residential, when you create that value by planning, right?
Yeah.
That's easier. Okay, so that was R2SA, overlapping with B2SA a little bit, like quite a lot, covered. We've discussed trading and flips. These are all service-based strategies to invest your money in properties. And the last one that we wanted to cover is sourcing. Who talks about sourcing?
Oh, yeah. You can talk about
sourcing. So you might have seen a lot of deal sourcers out there. And the reality is that deal sourcers, they don't have any money. And typically, I don't say everyone, but typical deal sourcer is a desperate person that looks for quick bucks. They don't have any money. They just call landlords. They have no fucking clue what they are doing. And they try to package and sell you a deal. And it's beautiful, right? Everyone is happy because they have no clue. You, when you buy a deal from a sourcer, pretty much you have no clue as well at the beginning of your career.
But they talk to you like they know the numbers. They even don't do the numbers for you, and they say, oh, this is it.
Yeah, it's going to work like this. But then they forget to add like, I don't know, like 50% of the cost into the table. They don't know it, right, as well. So they don't do it on purpose. But that's the reality. Sourcer sucks and you suck when you buy deals from the sourcer because both of you have no experience at the beginning of your career. So that's difficult, right? So sourcing is an entry-level strategy typically. I don't know many people who rely on being a sourcer long-term because like you do sourcing and you sell a deal for what? For £1,000. £2,000, £3,000. If you're a great sourcer, you sell a deal for £4,000. If it's a massive deal, £5,000. That's what you get for sourcing, okay? And you're way better off doing same amount of work, but if you're good, you can do trading right now, right? And not sourcing anymore. And then instead of having £3,000, you can have £33,000 for pretty much the same amount of work. You need to find the deal, you need to package it up, you need to sell it. It's the same shit. You just have way more money. So sourcing, be careful with sourcing because people can be quite desperate and they can sound way more I don't know, like credible than they really are. There are exemptions to the rule. So our very good friend Ethan, he's a very good sourcer. But it's an exemption. There are not too many of them, okay? So sourcing today is becoming way more difficult, especially in a residential space where you want to find R2SA deals, for example. It's pretty much close to impossible right now.
It's almost for some, it has become quite dead, right?
Yeah, because like the main platform for sourcers to source deals from landlords for Rent2SA operations was Open Rent, because you could reach out to landlords direct without having to build the relationships with the agents, and that was working for years. And that was a game of volume. So on like 100 calls that you make, you will have 99 rejections and one will be a hit. And out of this one hit, maybe 50% will convert to a real deal that you will package and sell. So this is very difficult. It was difficult and now it's close to impossible. So the sources that I know, they start, like the good sources that I know, they start to build tools around it. So they have to work with like companies building tools in India because they are cheaper developers to build a tool that automatically connects you to different countries via VPN to send inquiries to the landlords from different IP addresses automatically, so you don't have to do it manually all the time, to still be able to send inquiries for all these deals automatically, because otherwise you have to do it all manually and then it's very time consuming. And it's a game of volume again, so we need to be sending hundreds of inquiries, at which point Open Rent today just blocks you if you do it from a single IP address. So that's a challenge.
It's tough. So what they end up doing is sending hundreds of letters every day. Yeah,
that's it. And how does it work tax-wise? If you're a very good sourcer and you sell a deal every single day, how much tax do you pay?
Very easy. It's just the corporation tax that you need to think about. And same what I've mentioned earlier. You just pay it 9 months after the year end for your company. Really,
VAT?
Right? In terms of VAT, that's simple. If you go over a threshold of 90k, yes, but it depends on your turnover.
So turnover over 90k, it's not profit over 90k, it's turnover.
It's always turnover.
Okay, cool.
Always. For VAT, that's why it's such a cruel tax. It's just so, I find it enormously harsh because no one really cares about your expenses. Like nothing is going on in your world of business. You just look at what your income is in your bank account.
There you go, rant version 2.
Times 20%, off you go. This is your cut to HMRC. So this is what you need to do.
That's for the king.
But yeah, and it's just so important to check your VAT threshold every single month.
Okay. So that covers the service-based strategies that we have exposure to and we understand quite thoroughly.
Cash-based, like.
Yes. Yeah. So we've discussed 4 strategies or 5, whatever. Service-based, where you trade your time for money. So now it's the great time to discuss the equity-based strategies where you create your assets, you add value, and you fucking keep them all.
And
maybe you sell some, but it's like, the long-term game for most is to have...
But the idea is not to trade your time for money, right? The idea is that eventually you're going to bagger off somewhere to a hot country and you just get, the pennies in your bank account.
Yes, but it's well, to get there, you need to have everything systemized. So you need to have great experience yourself, create a team around the property investment business. So the business grows itself without your input, because for as long as your input as a director or major stakeholder is required to operate the company, then it's not really wealth, it's still a job, right? And there is nothing passive around it. So for example, if I disappeared from my company, nothing works, everything goes tits up now, right? So if we both disappear, then next week we are we have a trouble.
You need to start employing people, right? That's the idea.
Yeah.
And preferably more like smarter people than you.
It's difficult for me.
Well, that's an exception, but in general, it's good to employ smarter people than you are to run your company, right?
Yeah, but generally it works like this. Like, first of all, you create everything yourself. You create your first systems. You iterate through those systems yourself. You create a profitable business to the point where you have no longer any time left. You're deeply fucked, and you need to find some help. And this help, typically, you start with a cheaper help, like the admin help, basic help, admin tasks. Then you look at your repetitive tasks that are no longer as simple, but like accountancy and bookkeeping, most of these elements can be outsourced as well. But before you can do that, you need to create a proper company structure, understand how it works, automate the shit out of it, and then you can start looking at outsourcing.
Yeah.
So you have just like simple admins, but you know, someone not simple has to create it all, right? It's difficult.
Exactly, you have to look into the core.
Yeah, and after you've outsourced all the basic admin and repetitive shit, then you will start looking at people that make better business decisions than you, right? So then you're looking at people better than you.
Because you need to have that time free to think about like added value tasks. Yeah,
high value tasks. So it's very important for the exec to have a mindset and capabilities to make a very few very important decisions rather than, you know, painting the walls all day, because you save money in your company that way.
At some point, you need to let go, and this is what we have to do. At some point, we have to let go.
We have already started, but we are still creating the systems and iterating through them. So service accommodation is pretty much done. I would be able to disappear from the business from service accommodation. If we are not launching new units today, I would be able to rely on my team to run it for me, quite nicely. And it's been just a year since we've started outsourcing it. So we've got a fabulous property manager, and you will need a property manager as well. But in-house is better than third party. Okay, cool. So now we know what we want to do. We want to have equity and truly passive income.
Yeah.
Okay. So far, nothing was passive about the property. So let's start with the first strategy, buy to let. So buy to let. Maggie, does buy to let work today? What do you think?
It depends if you want to scale it. I mean, does it really work if you want to scale it? I don't think it does.
You need to keep injecting fuckloads of money.
How many buy-to-lets do you need to have to really like live on it?
Depends on the region. So I would say that with buy-to-let today, it works better up north. If you don't need, for once, something works better up north, right? One thing, buy-to-let, typically, for as long as you don't have to do a heavy renovation. Because why? Buy-to-let. What is a buy-to-let? Buy-to-let is a strategy where you cash out 25% for deposit to get a mortgage on a residential property that you then do nothing to, typically, keep it and rent it out on a single AST to a family, a student, a young professional, whatever, depending on the property. Yep. But then you always have this at least 25% tied up in a deal upfront. Then you remortgage like LTV, loan to value of the property, so of 75%, 25% frozen, 75% from your bank, and your equity in the deal is starting at 25%, but you need, in order to add more properties, you need to save up another 25% for the deposit, another 25% for the deposit, and that's quite time consuming, right? And you're freezing up a lot of money, and that's assuming that you don't do any renovation to it. And now the question is, does it really work if you buy a property that is in a good condition, good enough condition to be lettable day one? I don't think so. I think you need to buy a sheet hole to convert it to a good quality unit that is good for buy-to-let. And at that point, it's no longer buy-to-let. Now it's BRRR, whatever it's called, like buy, refurbish, refinance, and keep, right? It's the same thing, because you are still buying a property, converting it or renovating it and keeping it long-term as buy-to-let. And BRR works, definitely. Buy-to-let, I would argue, because if you buy a sheet hole and renovate, it will be way cheaper when compared to buying a property in a great state of repair. Yeah. Presentable, day one lettable.
I think with so many different strategies these days, surely if you're starting up just now and you haven't started building your buy-to-let portfolio 15 years ago, I would personally look at everything available to you, and we personally don't see buy-to-let as efficient, scalable strategy to earn money and build your equity quite fast. It's quite a slow
long-term
process, long-term.
And by the time you
investment.
start treating buy-to-let as your daily business, you quickly realize that this is not the best strategy to be following. There are better things to do, like conversions, where you add value by planning, conversions from commercial or mixed
Correct.
use to residential or HMO.
Because it's all about when you've got an injection of the cash flow and you've got in your hand, I don't know, 100,000 to begin with.
Yeah, let's say you have 100K. Yeah, you were saving up and slaving for your 10 years.
It depends what your aim is, right? Is it just like a side hustle business? You want to keep your full-time job and you want to just do a few buy-to-lets, fine, or just one or two because you've got enough money. But if you want to leave your full-time job and you've got only £100,000, think about how you want to invest it, how quickly you're going to turn the money around, right? So this is why you need to look into other strategies than buy-to-let.
Realistically, what can you do with 100K these days? You can buy 2 houses that require a little bit of refurbishment. In Northampton, I wouldn't say like a very good close city centre, outskirts of city centre, 3-bedroom, ex-council houses, you would get that for 100K today. 25% deposit. Let's say that they are like £200,000 each, so 40K each, plus light renovation, plus legals. That's it, 100K, and that's 2 buy-to-let units,
And then,
or
yeah.
or 1 sheet hall converted to a good quality BRR. Okay,
Exactly.
with a
So
high
that's
yield.
why, and then it's frozen, and then you need to save up. You know, again, how long is that going to take?
Yeah.
So
So shall we talk about the numbers then?
Yeah.
Okay. So before we talk about the numbers, let's talk about the VATs and the taxes and stuff. How easy is it to run buy-to-let?
Obviously, sorry, I don't want to say obviously, but residential properties are always VAT exempt by tax law, so you don't have to worry about that. It's just corporation tax. SDLT could apply always on residential, and that's quite
So every time you have
high
an intention to
values.
keep your shit, your assets, then you pay SDLT, stamp duty, land tax. Well,
But also, if you want to do a flip,
you always pay it, right? So intention
always.
to keep or not to keep, SDLT is
exactly.
always CGT.
Yeah, it's the capital gains tax that you're thinking.
Yes.
Yeah, so SDLT always is payable. Residential, if you always worse, more SDLT. So it's always better to buy either commercial and convert it to residential for SDLT purposes. However, now we are talking about buy-to-let. It's just residential. So SDLTG, no VAT, and obviously the usual corporation tax on a limited company. Now watch the space, because the government now is talking about introducing an additional made-up tax, being NI of 8% for all the landlords on residential rentals.
Thankfully, it's not the legislation yet.
It's not yet, but they are discussing it. So clearly it's on their agenda to add something on. Let's hope nothing is going to come out of it, but watch the space.
And now look at that. If you're a landlord running your business, under your personal name, you have Section 24 introducing, like, I think it was like 2015 or something like that, 16, 14, whatever, something like this. Section 24 says that you cannot use your interest anymore on mortgage as an expense to your business. So basically, all buy-to-lets under personal names, they are on negative equity, negative yield, which is super mind-blowing.
Yeah.
And now when you're holding your portfolio as a limited company, for example, or an LLP or whatever it might be, not a personal name, then you pay Section 24 doesn't apply to you anymore, but you have still your expenses and your margins are very low. The yield in buy-to-let is like anything between 0% to 10-ish%. So it's low. It's low. And then government wants to take 8% out of rental income. And income is not the profit, it's income, it's turnover. So take 8% of turnover in NI tax for landlords, and then you pay your expenses, then you pay your mortgage and everything else, and then whatever you are left with is your profit, which pretty much will be, if you had 8% yield, now you have 0% yield. Thank you very much, government. That's a great way of creating more stock of houses and flats in the UK.
And we've got a properties shortage in the UK, by the way.
A massive one. We are like a few 100,000 properties a year that are missing from the pipeline of creation of new properties in the UK. We need to be encouraged as small businesses, like SMB builders, to developers, to develop these assets. And for now, it's a shit show.
It's just. It would be nice if they really support creating new.
I feel like a criminal pretty much working in this space. Like I'm a bad landlord going after people's money, but in fact we are creating houses that people love living in. And when you look at I
think when you look at the amount of rundown and empty properties on high streets these days in some of the towns in the UK, and then you get private landlords converting them, right, and making a nice space.
Exactly.
And still, obviously you've got bad landlords, right? I'm not saying
not too many though.
You do.
90% of private landlords are considered good.
Yeah, but you still have some odd ones, right? And that's why the government wants to sort of
Maybe
regulate
you, not me.
it. Yeah, but let's focus on the numbers then.
Okay, now, so buy-to-let numbers, I've got it in front of me. So first of all, it's very region dependent. Without too much renovation, north is better than the south because you buy way cheaper beyond comparison, when the rents are fairly similar. Rent is way higher up north when compared to the purchase price of your asset, and that is why you have way higher yield. But we are not investing up north. We will leave it to other people. Maybe they are more brave than us, so we stick to the Midlands and South. It typically works better, even though you have a lower yield on buy-to-let, because you don't do buy-to-let typically. Okay, so we have still one buy-to-let. We had two. We've sold one, and now look at this. We've converted the money. We got from selling one buy-to-let unit that was giving us, I don't know, fucking £300 a month into 5 R2SA assets over time. So we've injected 100k, we've created like 2 high yielding R2SA assets. By the time we finish the second one, we already saved up to launch a third one, and then we launched the fourth one, and then the fifth one, and in like 12 months we've built 5 of those high yielding R2SA assets using money from one buy-to-let. So yeah, I will let you do the numbers in your head. Cool. So we still have one Stonyhurst asset in Northampton, and it works very well, to be honest. So Northampton is very good in Midlands for buy-to-let still. It just works here.
It's quite central, so I would say.
Yeah, it's very good. It's very good. But look at the numbers. We purchased it in 2019 for £145,000. 25% deposit out of that number plus legals, it's roughly £40,000 left in the deal. So we had to earn 40,000k at this point to own this property that had no windows, it was not lettable, we had wild cats living inside, broken garden doors, like garden was not touched in the last 15 years, it had to be landscaped, everything was shit. Like this was a proper rundown property. And now we had to develop this property into like a family 3-bedroom house that cost us £60,000 to develop it from scratch. It was back to brick, and back then it was possible to do such thing for 60k, including landscaping and materials. Everything is brand new. Every square inch of this house inside is brand new. So now the total cost is 205k, 145 purchase price, 60k development price, and now total cost is 205. Back then we had a shit mortgage advisor. I hope she's not listening. And we had the 75% LTV, but the LTV, loan to value, was calculated from the purchase price and not from the GDV, like a gross development value where we've created value in the property, at which point it was more than £210,000. So we've got just £110,000 mortgage, which leaves £95,000 in a deal. £95,000 left in a deal. What were we talking about having 100k? What would you do with that? You can do this, okay? Yeah. Back in 2019. So now, money left in, 95k. Monthly rent back then in 2019 was £900. Monthly mortgage and expenses, it was before COVID. The interest rates were very low, like 0.something%, which is unreal in today's market. So the mortgage on that like 111k or something like that was £400. Annual rent net income is £6,000. So money left in versus the annual rent income. So you look at the annual rent income, which is 6k, and then you divide that 6k by money left in, and you do times 100 to have a percentage of yield. And yield was 6.3%. 6.3% is still considered not bad for a buy-to-let, and that was back in 2019. It means that 6.3, we would need to hit 100% in order to have all our money back. So it will take us like, what, how many years? How much is like 100 divided by 6? By 5 is so like 18 years, something like that, so break even. Is that a good strategy? You also have equity gain, right? Throughout the years. Historically, you will double the value of the property every 10 years. Okay, so that was 2019. Now, we operated still in 2025. We still have this asset, still have money left in £95,000, but now monthly rent is 1,375, and that's big thanks to shit government, because they're creating such a massive house shortage. We had 40 viewings in a single day. It's such a high demand. You just should, and absolutely would and should, increase your rent prices, because they skyrocketed, you know. So because of that, we now have annual rent income £10,500, and also we have a little bit higher expenses. The rent is not the rent. The mortgage is now £500 a month instead of 400. It was £800 at peak of COVID. Now it's £500. So yield today is 11% on that property, and our equity in that property is around 50%, because it's gained quite a lot of value now. So that's good. 11% yield on buy-to-let property is good. Now let's play a little game. Maggie, if we were buying this property today, the same shithole, same Stonyhurst shithole property today, would it still work as buy-to-let? You still need to buy it, leave 25%, renovate it today using today's price of materials. Don't look at the screen.
I don't think actually. No, I don't think. Would it?
Okay, Maggie says it wouldn't. What do you think? Would it work if you buy a shithole property in Northampton, fully renovate it, and run it as buy-to-let?
Sorry, it's still working.
She's looking at the screen, so she's cheating. Now look at this.
You've done the numbers.
The same property today, a shithole, would be worth 190k. Okay, the development of that property today, it would be 80k roughly. So your total cost is 270k, and you've left 64k as a deposit plus legals instead of 40 6 years ago. So quite a big change there. 75% LTV from the purchase price. So let's compare apples to apples. Now is 142k. Money left in the deal today, this year, versus 5 years ago, is 127k today, 127,500. 127k today, money left in the deal, versus 95k 6 years ago. So a substantial difference there. Monthly rent still 1,375. That's what we get today. Monthly rent and expenses 500k. Rental income still 10.5k, but a little bit more money left in the deal. Today yield would be 8.2%, which,
assuming that the mortgage is as low as, right?
Now they're getting low.
Yeah, with the economy and your.
It's quite cheap now. Okay, so 8% today is not bad for buy-to-let, right? So it will take you just like, I don't know.
Did you increase the cost for renovation?
Of course.
Yeah,
of course I did. So
it's kind of
8%.
hard to believe that it will still work.
Yeah, in Northampton it works. So buy-to-let in Northampton works. We have friends, Tomek, for example, and they have like, I don't know, like 20
you need to
something.
Find your sweet spot location for that, because it's just.
But if you systemize it, if you buy under market value, if you have great team of developers, then you can make it work.
Yeah.
Okay, we're almost there. So also very important thing, your yield on buy-to-let increases over time, because your interest-only mortgage, if you don't add stupid admin fees every 2 years, please don't, then your yield increases because your property is valued more. That doesn't affect your yield, but your rent is more expensive, but the money left in is still the same.
Yeah.
So that's very, very important.
Right. Yeah. So another one, you've got buy, refurbished, and refinance, and with the intention to keep. So it's pretty much the same as buy-to-let, right?
Yeah. For me, buy-to-let is BRR.
Yeah. Because it doesn't make sense to do a buy-to-let resi to resi.
No.
You need to add value. We already said that.
Yeah, either value by planning or by redeveloping.
Exactly. Yeah. Same VAT, tax treatment and everything else as buy-to-let.
Exactly. Now buy-to-SA. So we've covered rent-to-SA quite heavily, but most of it is translatable to buy-to-SA. So development-wise, it's
a big one.
Yeah, but we'll discuss it also. Development-wise, when you buy buy-to-SA unit, you develop it, so it makes it pretty much the same as BRR or the same as buy-to-let, whatever. So you still buy it. You need to pay the stamp duty land tax. You need to do the development, pay your contractors, buy materials, like same shit. Then operations of service accommodation portion of this holiday let is exactly the same as R2SA. Nothing changes there, so let's not go there. And tax-wise, how does it work? Tax-wise, Maggie, so operations, is it the same tax-wise, B2SA versus R2SA?
Yeah, so exactly the same, because obviously the intention is service accommodation, right? So similar strategies we've talked about earlier. You have to consider, whether you want to do it through one company, which we obviously don't recommend. It's pretty obvious.
At this point, yeah.
Yeah, at this point, you can have a look at the Tom's two-way company setup. Now, the additional, again, you've got stamp duty land tax on resi to resi, unless it's derelict, right?
Yep.
But it's always there.
Talk to us about the new addition. Voted in by the new government, the ATED tax, my fucking favourite.
You've got the ATED, and honestly, I cannot remember what it actually means, but you can have a look at that. But ATED is basically...
means anal treatment extremely deep.
So, but basically, if the residential, or if the property that you're buying is over $500,000, you need to pay extra tax. Have a look at some of the reliefs.
How often
but
do you pay
if you want to keep it,
Maggie, how often do you pay that
you
tax?
need to make a declaration straight after purchasing it.
But tell me, how often do you pay that fucking ATED tax?
Once a year. So
Once
it's
a
like
year.
ongoing. It's not like you pay and forget. So it's ongoing tax that you need to pay over $500,000. Only when you want to keep it. Have a look at the exemption. If the intention is to use a third party independent company to run it for you, SSA, that's exempt for ATED. Again, you need to make a declaration. And if you want to sell it, again, you don't have to pay it at all. But again, you have to make a declaration.
This is just wrong. And what if you increase the value of the property and you purchase it for $500,000 and now it's worth $1.5 million?
What do you mean?
Do you pay
ATED?
ATED
That ATED is not based on what...
GDP, it's based on the purchase price.
Exactly, yeah.
Thank God. Thank you very much, government.
Hang on, I think so, yeah.
Okay, we'll clarify it later, because that's a good new question in my head.
That's a good question, yeah. No, actually, no, it's not true. No.
GDP, don't tell me that it's calculated from GDP.
Yeah, that's true.
So for our coastal asset that we purchased for over $500,000, we would pay £4,400 today.
So that's why you do the filing every single year, you see. They're clever.
Okay, so our GDP will be 1.4 mil, at which point we'll be paying what, fucking £12,000 every year of ATED tax?
Yeah, you need to have a look. I mean, the thresholds are not as bad, but yeah, you need to have a look at the thresholds.
Okay, but today is definitely $500,000 worth of a property we purchased, and the ATED was £4,400.
Yeah, it wasn't too bad, right?
Yeah, 4.4k, peanuts, right?
It all adds up. But yeah, so when you think about ATED, and then when you think about your B2SA, because you've got two types of tax, almost like glitching, you've got two strategies. So think about it, because you can put you can run into a corner, because you can say, oh, I'm exempt from ATED for this purpose, but actually now I need to pay VAT on because I haven't think about two-way company.
This is
so
just craziness.
Have a think, because you can think that you're sorted out in terms of ATED, but now you're stuck with VAT, and you don't want that, right? So yeah.
Okay. We've been talking for almost an hour now, and we have one last strategy to cover. So let me make it nice and sweet. The best strategy we've left for the last.
Yeah.
Okay, so that's what my son does with his breakfast. Like today, he had porridge and a toast with a jam, and then he had it a Swedish way. You have a strawberry jam and you have a fucking cheddar on top of it, which is crazy, right? In the UK. But we have a family in Sweden as well. That's how they eat it. And he ate his porridge first because he don't like it, and then he got his toast later. So that's the same with the strategy. So the last strategy for today is equity-based, the commercial mixed-use conversion to residential or HMO. So I'll say it again, it's either commercial or mixed use. Mixed use is a property with an element of commercial converted to residential, purely residential, or to HMO. HMO is very close to residential pretty much. So we've done it twice now. Mosley and Swaddling Coat ongoing, Mosley finished. Let me tell you that, It's fucking difficult to achieve, okay? It's very difficult because you need to have a lot of technical knowledge to make it fly. So you need to understand the entire process. The process, like I think I've created a spreadsheet now that has over 100 steps to make a conversion fly, which is a lot of steps, okay? You need to stay on top of all of it. Then you need to buy the property for a good price. Then you need to understand the planning process or have people that you pay that understand planning process and they're not too cheap. Then you need to have a construction contractor. So we are quite lucky with our magical Romanians. They are very good. Then you need to have SAP assessment surveyor. Then you need to have the noise, vent and air surveyor. Then you need to have a parking beat survey surveyor. Then you need to have building regulation guys that check your site every single milestone. Then you need to have a PCC, which is a professional certificate, whatever, professional consultant certificate, PCC. That's a warranty for roughly like 8 years, let's say, for your property that your remortgage lender, they will require that you have before they give you their money. You need to have what? Mortgage broker, insurance broker. So that's your team that you need to have to make that happen. Most importantly, you need to have a vision. So you look at the shithole, a bad-looking asset, and a boring asset, worn-down asset, in a bad condition that people, they are afraid to buy because there is so much wrong with it. And you need to come in and come up with a plan how to fix it by adding value. So ideally, you have no money left in the deal once you're done. That's the idea, okay? It's not often possible, but it is possible still, even in today's market. Okay, and then you have the vision, you have the property, you bought it for a good price. You need to have a low risk on that strategy, if possible. So by lowering the risk, you need to have multiple exit strategies. So do you run it as HMO? What if you cannot run it as HMO because of something? Can you run it? Can you sell it? Can you run it as buy-to-let? Yeah, exactly. Can you subdivide it into, like, I don't know, flats? Yeah, so you need to know that. And tax-wise, very quickly, we've got the commercial conversions, swaddling code Mosley stuff. How easy is it when it comes to taxes and VATs and all this boring shit?
Right, so when you purchase commercial, so we're talking commercial or mixed use to residential, if there is a VAT already included, yes, you can recoup this, or you can maybe use that form I mentioned earlier, 1614D, that basically allows you not to pay VAT at face value. But if it's not possible, then you need to recoup it at the VAT later. And that's what you want. You want to get the money back on the VAT you've spent on purchase, right? And you do it via the two-way company setup. You've got the equity company, you've got the property that is responsible just for residential, right?
So like a development company and operations
it has to be
company.
a subsidiary of the equity. So yeah, so a development company, then you've got operations company.
So you buy the asset with the development company, you develop this asset there, this development company owns the operations company under it as part of holding.
So you develop it, renovate it, do it all up. In the meantime, you register it to VAT. You get the money back via the VAT return on the basis that the intention is to rent it out as residential asset by transferring the major
interest
concern. What is it called? The major. You basically transfer the actual ownership from Zen Equity to
Zen Propco.
to Zen Propco.
That's our companies.
So it's sort of based on zero tax because effectively this is like the basis for that return. And then obviously your residential Zen Propco company is residential, VAT exempt, so you can just run it as a sort of a regular rental business, right?
Yep.
What else? Obviously, SDLT applies on commercial. It's a lot lower, and that's pretty much it. Obviously, you're a limited company, so you pay 25% normally on
corporate tax.
Corporation tax. Anything else?
When you sell.
But yeah, when you sell, you will again. No capital gains tax because that would be included in because you're not a person, you are a corporate.
But I had an intention to keep to begin with, but I've decided to sell at the end of the project when I developed it. What's then? I still don't pay CGT, do I? Because then I change my intention and I say, I always wanted to sell.
No, you still don't, because you're a person. Because you're a company. So it's gonna that is sort of incorporated in your corporation tax return, right?
Oh, that's good.
It's still gonna be incorporated. You're not gonna get away with that influx of, with the added equity. You're still gonna pay some corporation tax extra, right? But it's not gonna be. It's gonna be different thresholds are gonna apply.
Cool. That makes sense. Okay, so that's it when it comes to the strategies. Closing notes now. So we've discussed the service-based strategies to invest in property, equity-based strategies to invest in your property, and taxes around it, company structures around it, high level.
Very high level, yeah.
If you have any questions, please do reach out. So you can go to our website, zenproperties.uk, and you will find our contact details there. And now, very, very quickly, if you want to do what we do, where do you start? So starting your property journey, typical for most, you start cheap, you start quick, you start service-based first or buy-to-let, but then you keep growing your service-based, you keep growing your buy-to-let, you realize it doesn't scale too well, so then you move probably to a HMO as a second step. You still convert from residential to HMO. It scales better, but it's still not massive when it comes to the scalability. Then you start doing a development or a conversions, and that's probably the end goal for most. It's complex, but it's creating more value through planning or through creating something out of nothing. So that's where you want to be. Now, what will you do if you had no money and no investors? So that's where most of the people in the world are. They have no wealthy friends, they have no investors, they have no money to start, and they want to be property people.
You can be a sourcer.
We've discussed that.
I know, a sourcer, or just work for free.
Yes,
people.
Work for free for people. I like that a lot. So you start listening to people that are more experienced than you. I don't say us at this point, but like XP property guys, for example, just get a phone call to them and say you want to work for free for them. They will say yes, okay? But you will learn fuckloads of stuff based on that.
Also, go to a property events, blend in, get yourself around other savvy investors.
Exactly. And it's a very cringy phrase, your network is your net worth. Fuck me. But it is kind of true, right? It is kind of true.
Yeah.
And then learn tons, okay? So like keep smashing this YouTube's books, buy fuckloads of books, and just like listen to people with more experience than you. And start small and grow bigger, save, and then start getting bigger and bigger assets under your belt. Get investors on board, even if it's small investors, like, start with 10K, 20K, 50K. That's where we started. Now we're at, like, when it comes to lending, we start taking like 100K, 200K loans. So it starts to scare us a little bit, but you have bigger tolerance for risk as you grow. And then, next year we'll be taking like $500,000 here and from the investors. And that's the plan for growth for us. Cool, and then deliver, rinse and repeat, and just have more and more credibility and start building bigger things. There we go, you're sorted. Now, what if you had some money and no investors? What would you do then? You have some money, but you don't have investors. So that's us 2 years ago.
Yeah, so you can start with cheap service accommodation, right?
Can do, still.
Can do,
sourcing.
You can do some trading, you can do some sourcing, which I've mentioned.
However, if trading, I would argue it's very much doable, but you need to be extremely switched on and you need to be educated
heavily.
Once you've
got knowledge, right?
Because it's a heavy knowledge to be a good trader.
For sourcing, you don't need any money, right?
For sourcing, you don't need any money, no. Right, just your time and determination and basic knowledge.
Yeah.
Yes. So maybe start there.
Yeah.
And now, what if you had no money
and no
time?
Yeah, that's
a definition of fact, isn't it?
Yeah, that's not a good position to be in.
Yeah, you need to make time. Okay, so time is the thingy that everyone struggles with most. Okay, not the money, it's the time. If you have time, you will have money.
And if you have to, you work at night. You add on extra hour in the morning.
Yeah. When was it the last time we watched a movie together?
I cannot remember when we've watched TV in the evening or we went out for dinner. I cannot remember.
I remember
honestly.
Last dinner. It was my birthday, must have been 5 years ago now.
Yeah. Was it 5 years ago?
4 maybe.
But that's don't I wouldn't recommend it.
Yeah.
It's not a good work-life balance.
Yeah, but we are chasing to have the critical mass. Critical mass is where you can start relaxing a little bit, slowing down, because you have your processes, your team accumulating wealth for you, and ultimately accumulating wealth is why we do that. So we want to not do it our entire life to this extent. We want to slow down at some point, okay? So the most of the happy people that I know, they are slowing down and not going more and more crazy.
Yeah, because it just never ends, right? You just want more and more and more. But yeah, we'll see when we get to the point when we can actually relax, whether we actually remember how to relax. Because
I wanna have a fucking yoga retreat in Sardinia.
Yeah, that would be nice. But then you get into the point just like work, and that is the usual. It's not
But
the usual.
then you have a second yoga retreat in Sardinia, then you start growing into Corsica, right? And then you start having like a chain of yoga retreats globally.
That's what I mean. Like you kind of need to
it's
decide what you want to...
It's so difficult to like put your entrepreneurial mind at ease, isn't it? Like you need to satisfy yourself by going fucking crazy. I hope that I will develop
That's a completely different
skill.
subject, right?
Yeah.
I guess it's a skill to know how to relax.
Okay, 1 hour and 10 minutes. So guys, apologies for a super lengthy episode, but I hope that you have some value out of it, to know where to start, what to expect, and what to invest in, and how to invest in it, and what works, what doesn't work, and what yields to have from the
how to manage your cash flow. I hope it did help. Any aspects of of the tax.
Yeah, the only things that I can't really tell you is how to manage your wife, because that's a fucking impossible quest.
No, that's hard. That's a hard one.
That's what she said.
Yeah, thank you again, guys. Take care.
Love you. Bye.
Bye.